you need to mock up a deal. To get really comfortable talking to investors, you need some materials, you need some marketing before you go put an offer in on a place to buy something where you don't actually have all the money.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McLeod. Let's go, baby. All right. Welcome back to Agents Building Cash Flow. I'm your host, Randall McLeod. Thanks for joining me today. Today is going to be an awesome episode because I'm talking with another operator in the space. His name is AJ Shepard. He is with a company called Uptown Properties out of Oregon. They're a vertically integrated real estate company. So they have a very similar, like his background was very similar to mine in that he started out investing and fixing and flipping and doing that sort of thing with his brother. They started a property management company. They started brokerage. And now they're doing syndications. They're moving on to larger asset classes, the multifamily space. So just talking through his trajectory and how they manage that many vertically integrated companies is very helpful. We dig into some details a little bit on a deal. So if you're a deal junkie, you want to hear about that, listen through to the end because talk about one of the syndications that they just did. So it's very cool how they're operating and what they're doing, and even the types of assets they're going after for a syndication. So interesting having that conversation. And then we also talk about just creating processes in order to manage many different verticals and to have different companies operating at the same time. As a high-level operator, you need to set systems in place and have processes in place. And so we discuss some processes that he learned, and he shares those with you so that you can implement those in your business so that you can grow as a real estate professional. So very cool conversation. Again, if you are interested in the single family investing world, I put together a free course. You can go to commissiontocashflow.com and you can get access to this free course. It's going to teach you about wholesaling. It's going to teach you about sub-2, buying notes, investing in notes, doing owner finance deals. Just a lot of stuff on the single family investing world. Some of that stuff can apply to the commercial space, but that's going to be available, right? So if you're interested in that, please go there. It's a free course, sign up, and then we're going to get you access to that. What we're going to do as well, I want to start talking more syndication stuff and fund level knowledge so that you can grow your knowledge base there and get more comfortable with what a syndication and what a fund looks like so that you can actually start investing either as a limited partner in those deals or you have a better idea of how to structure those things yourselves if you're looking at doing those types of deals. So again, register at commissiontocashflow.com. That course, the actual syndication, the commercial real estate side is going to be coming out later. Also going to be free. It's going to be a high-level course just so that you can get your feet wet in understanding a little bit more details about that. So thanks for joining me. The audio on this may be a little weird. I've got two different computers going on for this episode today. So hopefully it sounds all right for you guys. And as always, if you're getting value out of the show, if you can go on and wherever you're listening to the podcast or watching the show, if you can just give us a rate and a review, it's hugely helpful. Just the written review is a big thing about the show, and I would really appreciate it. So let's bring AJ on. Let's get the conversation going. All right, AJ, welcome to the show. It's awesome to have you on. Thanks so much for joining me. Looking forward to diving into this conversation because I was doing a bit of research on you and seeing all of the stuff that you guys are working on up there in Oregon. First thing I'd like to talk about is property management, honestly, because that was one of the first things that I saw that you guys had on the Uptown PM. And so before we get into that, why don't you just give us a little bit of background, kind of like where you and your brother are in the space and like how the company's structured, because it looks like
sure.
Multiple verticals.
Yeah, no, we're definitely vertically integrated. So my brother and I started buying rental properties back in like 2007, 2008. We opened up a property management company and a construction company in 2011. And then we started the brokerage company like 2017, 2018. And then 2020 started doing syndications. And if you're not familiar with syndications, it's pooling investors' money together to buy larger properties such as apartments. So we kind of just took our key kind of focuses and just have added on to them as the time goes on. So with property management, kind of started that like in 2011. And really it came about because we had bought and held enough properties that were like, hey, this is kind of like almost a full-time job, maybe not a full-time job, but certainly it was either we needed to hire a third-party manager or we needed to do it ourselves. And we've always been kind of bootstrappers, get in there, do it ourselves, learn how to do it, and then hand it off to someone else. As we've gotten older, we've gotten better at that delegating piece, especially with employees. And I think that's kind of allowed us to scale in the last like 5 to 6 years a lot more as well. Some introductions to some like associations. I'm big in NARPM. It's the National Association of Residential Property Managers. If you're ever looking for a property manager, that is a great place to start to look for one. So I volunteer for them as a regional vice president, manage the chapters in California and Hawaii, and talk to property managers fairly frequently for that. And then we also took part in EO, Entrepreneurs Organization. And this is a great organization that taught us just like general business skills. So we both kind of joined those associations around 2014 to 2015. And since then, it's really ramped up and scaled our businesses with employees and then just with kind of processes and what we've done. So awesome. That's kind of a background quick.
Yeah, no, that's solid. I'm curious on the property management side.
Yeah.
Again, so you got started in 2011. Before that, even, so were you an agent? You were in real estate because you were a real estate agent, or you got in as an investor and all you were doing was investing? Because it looked like your history was construction management from Texas A&M, Gig'em. All right.
Yeah, I had an industrial engineering degree from Texas A&M, and I actually did that while I was working for a general contractor. The general contracting was like heavy industrial contracting, so I worked on like really big stuff: gold mines, silver mines, steel mills, paper mills, just doing heavy infrastructure lift there. Millions of dollars of projects back in early 2000s, late 2000s, which nowadays would be even more money. But we did just like heavy infrastructure. So I had access to resources, contracts, access to all sorts of, different labor. We would typically travel places to go to jobs. So we'd work like 10 to 11 months a year. So there'd always be a month off. So most people that do contracting have friends that do contracting. And so we'd be able to find names of people and then just hire them directly. So that kind of is another reason that we kind of came to really bootstrapping stuff ourselves and just learning how to do a lot of the work ourselves. I was around construction and like knew how to run saws, knew how to run heavy machinery, learned how to do that stuff kind of on the job. And then I would take those skills and bring it back to working on a house or working with some other people on a house, working with my brother.
Yeah, again, so you were on the construction side of investing, and was your brother out buying, or like, how did you guys, again, were you an agent when you started doing all this stuff? Because now you have brokerage. So
we started using an agent. His name was Eric. And it was kind of like right when we always looked at bank owned assets. We would go in 2007 was kind of the top of the market, 2008, 2009, 2010, 12. Just the market went straight down and there was so much real estate out there. I mean, we would go in and just put in offers that were ridiculous. And the people that came back to negotiate with us is who we would really kind of start talking with and then like look at a little bit more. So for the first couple of years, we looked at properties with an agent. And then my brother went to school and then became an agent and hung his hat another person for like I think it has to be 3 years or so. So he started performing just our real estate sales and purchasing. He didn't like represent anyone else. And then the state of Oregon, there's like a 3 triangle tier. It's like you can be a principal broker and you can practice property management and brokerage. And you have to have like a certain amount of experience to get up to that. And I'm pretty sure a lot of states are like this, or you can start out as a property manager, or you can start out as a broker. And so I started out as a property manager and my brother did the broker route and then hung his hat under someone else. And then I practiced all the property management.
Got it. Yeah. That's helpful to have somebody that's doing a different track, but you guys are working on the same thing towards the same end. My brother and I have done some work together as well. He came from the corporate world and then came over. We were doing a bunch of wholesales together. So, but it sounds very similar as far as you guys.
Yeah. I mean, from an investment standpoint, like years after college, I had a strong W-2 working for that contracting company. So we were finding the deals together. Everything was online. We were doing DocuSign at that time too. So I was traveling like kind of all over the West Coast and even the world. And we could still like do deals. And my brother would help with the planning of like the construction, come up with the Gantt chart, come up with scope of work and all that sort of stuff. And then he would make sure the guys showed up and make sure they got paid every week and just kind of go through projects like that. We were big into value add, a lot of stuff. Early on, we took on some like really heavy permits. Just like we bought a place for $100,000 and then we put $100,000 into it with permits. And like the length of time that took, like looking back on it, that's not something that we want to keep doing. So we tried to like do projects that were just underneath the threshold of requiring a permit. And that's kind of where our value add comes in, is like we're looking at redoing cabinets, countertops, replacing all the flooring, repaint, fixtures. But, we're not trying to move any big plumbing fixtures or move any big electrical fixtures. And so that's kind of our model, which I think there's a lot of people out there that do very similar.
It's funny because for the longest time, I wouldn't do anything as far as like moving walls, replumb, rewire, those sort of things, because it's easier. You can get in, get out. And then I think I was watching HGTV and I was like, these guys are doing it. Tarek's making all this money. Oh, yeah. So I was like, I'm going to do this whole thing. It was like one of the first big rehabs I did. And it was a nightmare just getting the permits and getting it, it delayed everything significantly and it didn't make me any more money. It was like, bread and butter, go back to the bread and butter. Similar path, it sounds like, because that was what we did. I focused on value add, build the war chest sort of stuff, picked off some notes and did some stuff like that here and there. So just kind of curious again. So you guys started on the property management side. Were you focused on single family or were you focused on small multis? What were you targeting for your property management business?
So we started the property management as a kind of support system to our properties. And so we were investing in single family homes at that time when we started it. At that time, those deals looked pretty good. We could buy a single family home, we could add value to it, and then we could refinance it and we could pull nearly all of our capital out. And in some instances, the bank would be paying us money to do that project. So literally owning the property for free. So when those deals were around, we were doing those. I'd say 2012, 13, that kind of market started to drop out just because more people came back to the market from the 2008, 2009 crash or the Great Recession or whatever you want to call it, as they started coming back into the market, which started driving up prices and then driving up everything else. So that kind of dried up. And that's, for single family homes, that's definitely where we are today. That really caused us as investors to move into the multifamily space. So we first started out with duplexes, and then we did a fourplex, and we're like, oh man, I think it was 2013, 2014, we did our first fourplex. And we're just like, holy cow, the metrics and the numbers on this is so much better than single family at the time. And so we're like, this is amazing. We should just keep doing more of these. And that's kind of how our career has kind of kept us, and we keep that trajectory going up in larger projects, is that every time we take the next step, we're like, oh man, I can't believe I was doing this the other way earlier.
Yeah.
But markets change too. When we were doing single family homes, they were priced very correctly. Brandon Turner coined the 1% rule, or BRRRR. We were doing BRRRR before it even started, or before it was ever coined that.
Or before it was cool.
The 1% rule, kind of abounded everywhere in that time period. So we were lucky to capitalize on low interest rates, capitalize on low prices, and then higher ratioed type rents. And so we've kind of just followed, trying to figure out where our investments can be much like that. And that's where we've kind of landed in multifamily now.
Yeah, I saw some of the stuff you guys were doing. You just did a syndication. Is that accurate? Maybe not just. Maybe you guys did that a while back, but you did an 8 or maybe a 9 unit deal. And then you have another 44 unit deal or something you guys did as a JV. So I definitely want to talk about those and kind of discuss what that looks like and where you guys have gone in the ramp up to you guys building these different verticals, just on a business perspective. I'm very curious how you guys were managing the multiple verticals, because as you added the brokerage, were you guys bringing people on, or were you having, just kind of, walk me through that. So is the property management, you scaled that to what before you started the next vertical?
Sure. So we started the property management and construction. Again, both of these were to support our own properties. Having that control in that business was really where our bread and butter is, our investments. So we're running these companies to make a profit. It's not like we're living off that profit. We're mostly looking to buy more properties, invest more, create more passive income through that way. It's less taxes to pay. Active income is a lot more taxes than passive income. So we really support the passive income and a lot of different tax strategies that you can take advantage of, such as cost segregation and other stuff that come along with properties. And if that income is passive, you can write it off and you can keep more money in your pocket and pay less taxes, even though on paper it may not show that you make a lot of money. So we ramped up, let's see, in 2018, we were probably at 400 or 500 units, I want to say. We've got a couple apartment units that we manage for a developer, and then another syndicator, and a lot of small multifamily, but then a lot of single family homes. 2018, I want to say it was 2014, 15. It's kind of when we found EO and NARPM. And that's really when we started hiring more employees. Probably up to then, it was like an assistant and then a leasing agent and then us two. And we were managing like 200 to 400 units. My brother and I were still writing leases. We were still taking tenant calls. We were still holding open houses. We were just like kind of hustling and doing turnover work, doing maintenance calls, just trying to like really hustle and make the business profitable. So once we got into those organizations, they really kind of like taught us create processes, create systems, create things that allow for the work to be done the same way and the ability to delegate it to someone else. So we really took that on and started hiring more employees. We also found employees in the Philippines. So we employ multiple people out of the Philippines that are college educated, speak English, and work our hours. And so we have them do a lot of tasks for us now. So we're probably more heavily resourced than most companies just because of the economic advantage that we were able to do and pay those people. As we continued like through 16, 17 and up to 18 to open in the brokerage, there was a significant amount of profit and not a lot of work in the brokerage. Property management is very labor intensive. And so my brother and I spending a little bit more time on brokers and bringing those people in, we could kind of really turn the lever for the company's profit. So we have done that. I think we have like 3 or 4 brokers. It's also promoting the employees within the company to also get their broker's license so that like, hey, a tenant comes in and you're like, hey, we already know what your credit score is, the company. Like we should be able to market to you and see if you want to buy a house and move into something. And then also with our owners, there's the opportunity if they want to get out of the landlording game, we can sell their property, or if they want to buy more, we can help them buy more.
Yeah.
And then knowing specifically about like multifamily investments, it's like, all right, let's move you into not a single family home that's not a real big moneymaker, and let's move you into a duplex or a fourplex where you can really leverage your money up and get good returns.
I love that it all feeds, like the funnel just feeds itself. So I got a couple questions for you then. So you talked about the EO system, and is that tied at all to like Traction and Gino Wickman?
Yeah.
Is that kind of okay?
Yeah, that's
okay.
So yeah,
Big
Entrepreneurs Organization, they really promote Gino Wickman's Traction and scaling up.
Yeah, I mean, it's a huge game changer for us too when we started.
Yeah, it's just like, system. I mean, if you think about it, it's like an operating system that your computer has. Like you can run Linux, Windows, Mac. It's like an operating system for your business.
Yeah.
And not everyone's the same, right? You can customize it. You can have different images, you can have different programs, you can have different whatever, but it's kind of like the backbone of the meeting pulse and stuff that he provides in Traction is pretty amazing. We use the delegate and elevate form a lot. When I'm telling people how to work with people in the Philippines, that's usually the first form that I go to is like, what are you good at and like to do? And then what are you not good at and do not like to do?
Yeah. What do you hate? Yes, exactly. Yeah, I have a column on my Asana board that is like, what do I not want to do? And then every time I do something, I put it in there. It's like, okay, this thing's going over there. It's going to be delegated. So on that point, I wanted to talk about, I guess, the going through that system. What would you say one of the biggest strategies that you learned about how to create a system? And the reason I'm asking this is because I talk to a lot of agents. They're trying to grow their business. They're trying to figure out how to make more money actively so they can then invest passively. So we're going to get to the passive side of the passive investments. But in setting up a system that works, it takes a lot of time and effort. And so I'm curious, you went through that process, that program. What would be one of the biggest things pieces of advice, I guess you could give someone trying to set up systems for their business?
We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com.
So usually I try to start out with a process flow diagram. So you can literally take a piece of paper, draw some boxes, and just be like, all right, the client comes in, and then next kind of like bigger and like looking at it from like a 40,000 foot level. So kind of go through there and just try to add in all the steps that there is. And obviously you can do the same thing on an outline, but this is just kind of visual and just like how they tie to each other. Like on an outline, you may have to go back to the start in some aspects, especially with the property management. Like a tenant moves out, either you're going to renew the lease or you're going to go move back in or you're going to get a new person. Like there's different connections that can happen visually. So I try to draw it out visually. And then after that, it's like, okay, then this doesn't happen overnight either. Like
No,
it's something that's like you try it and then you refine it and then you try it again and then you refine it and you just kind of keep going in this circle. And like, we still like change our processes in property management. In Oregon, we just had HB 1201 pass, and now all of our evictions went from 72 hours to 10 days. And so like we have to go change that process. Like it's just not something that's ever going to be just a piece of paper and just sits there. It's definitely going to be ever changing. So I started at like 40,000 foot level and then like go down and dig into like one of those boxes and be like, okay, in those boxes, what are the actual steps? Write those down kind of like on Word, Excel. And then once you've kind of like written down all the processes, how to do everything, then really kind of come up with your core processes. Like what are the ones that absolutely have to get done? What are the ones that are nice to get done? And then it's going back to those core processes and making sure that those are delivered to new teammates. So that's kind of like the overall arching of like what we do. We're in the process of doing that for our syndication company. And I will say kind of like one tip, like once you get employees or people to help you out is I generally have them develop the process. You know, I have kind of like a general idea, but I'm like, hey, I want you to do this. And so the other thing that we do is we do videos. So we'll take Zoom, kind of like what we're on right now, share your screen and then do the process on screen. So what that does, it also hits people's audio, visual, and kinesthetic learning types. So not everybody learns the same way. So having these processes written down and so they can be assimilated in different methods of, I'm going to say the same word again, assimilation, allows for people to learn in different ways. And that helps them learn faster, quicker, and gets that learning curve down a little bit more. So the last thing that we do is we'll bring on a new employee, have them go through all the old processes and then ask them like, hey, what's different? And then we'll actually have them go through and make new videos of the same thing so that they are talking through that process. And then it gets sent over to me. I can review it and I can be like, oh yeah, it looks like they know how to do it. If there's something wrong, then we can correct it. But then they actually know how to do that exact process.
Yeah, I love that. So that's a big thing in EOS as well. We had an implementer come down and he was talking to us. And so just to add to what you're saying, because it's very important when you're trying to go and actually create a company that can scale to have these processes down. And so what he did and said, do that visual as it is today. And then somebody would go through and then like, okay, this is what it looks like. And like, oh, wow, that's terrible. Okay. And then one guy thinks it is not what another guy thinks it is. And so there's clearly a disconnect. And so then you say, okay, here's how it should be. And then you go and you actually create the should be. And then what you can do with that, obviously, then you can give it, like you said, to new employees. Instead of having to retrain all of that, it's there. It's a process map that people can follow. And day one, they understand, oh, a new client comes in. This is the whole flow of how I get them to actually close the deal. And so I love that, man. It 100% is hugely beneficial. And now everything that I do, that's how we implement processes. So take that advice. One thing that I will say, you were talking about drawing it out. One tool that we use, and I don't know if this is across the board, our implementer was one that introduced me to it, is Lucidchart. It's a way you can create process maps. There's a paid version, there's a free version, but when you create it with a team, you can put links in there. So if you have like an actual predefined process within a process or within swim lanes or whatever, then somebody can click on the link and it will take them to like the explanation page of that or a video explanation page of that. You can do it within Google, I'm sure, like Google Docs or something, but it's just not as intuitive. So that's one. And then when you are creating videos, one thing that we started using was Temi, or any kind of transcription. So TEMI, you can load a video in there and within seconds you have a full transcript of that video. And so if somebody does learn better through the actual reading portion of it, or you just want to have like written right next to your video, you can do the exact same thing. So it's just a quick way to have both in there. And you don't actually have to ever write anything down. You can just do the video, do it, edit the actual text, and then you have the whole thing in there.
Can be like a new AI?
No, it's an old TEMI. It's been around for a while. There's a number of transcription apps or websites. That one was just super easy. And we just, again, you throw a video in it and it's got it all put out. So just for anybody else, if you're trying to write a book, if you're trying to like do anything, you have all the stuff you're trying to reproduce or regurgitate content that you've already created. It's a super simple way. Like if you've created a video to now say, here's my ebook. I'm gonna turn what I just said into an ebook, and then it's like a free resource you offer people. Hopefully that was helpful to go through that process for somebody listening. But I love the fact that you guys are doing that. So let's get back into real estate though.
I had one more comment on the processes that I forgot to mention is that now we've actually moved to like dynamic processes. So we have a program, it's called Lead Simple. It's a CRM. You definitely have to pay for it, but it has automation attached to it. Other similar kind of project management softwares that you can use are Trello or like Asana. And then if you really want to get into programming, Process Street can be programmed for processes. I've known people that have done that using Zapier too to automate tasks. We use that a bit, but we definitely had some consultation on how to set it up. But the cool thing about Lead Simple is like we can go in and just like change the process, and all the templates are there and everything that like are associated with the business. So it's very uniform, even though there may be multiple people performing the same job.
Yeah, got it. It's very helpful if you have the CRM set up with your process already set up in there. Okay, very cool. So let's get back into real estate. So you guys have the brokerage, you have some agents in there. What sort of stuff are you guys doing right now on that side? Are you pushing that, or is it really just geared towards your own property, still scratching your own itch?
Yeah, my brother and I really just perform on our own sales. We do, I don't know, a few fourplexes a year kind of now, but we're mostly geared on larger multifamily. That's the syndications. We do have brokers that some of them work for us as leasing agents. Some of them are just brokers, and like they perform real estate on the side. We manage that as like a principal broker, make sure that they've got all their docs and that sort of stuff. We're not like actively trying to grow that business. We kind of have a niche as like very much like an investment firm and so small investment, and there's not a lot of people that have the amount of knowledge that we have in our area. So there's a couple other companies that are like ours, but it's not a huge thing that we're spending a lot of time on right now. So yeah. I would say we're more spending time on the syndications and doing larger deals.
Awesome. Okay, so let's dive into that then, because that's very similar. Again, the path you guys have taken, it's just like I've heard it in my own life. It's so
yeah.
So talk about, I guess, specifically, because I'm curious, I want to be a deal junkie and listen to you talk about maybe your first syndication and like how it came about, and then like how you guys just ran that process.
Sure. We actually coach real estate professionals. Like our podcast is geared towards real estate professionals that want to take that next step in investing, which I think is very similar to yours. So I do coach a little bit of syndication. Our first deal kind of came, we were actually at like a conference in Vegas, and it's not our first deal, but this is like preamps our first syndication deal. And we're like, hey, this 2 fourplexes right next to each other came across our desk, and it was like 1.2 million, and we were in Vegas, and I think we had to like come up with an extra $25,000 or $50,000 to get it. And we're like, yeah, let's just do it. That was kind of our next step. A lot of our capital was going into that. We bought that just ourselves, and we had been learning about syndication. And so syndication, for those in the audience that don't know, it's very much an LLC structure, but it has different class members. We do just a couple classes, Class A and Class B. Class B is like the managing. Class A would be kind of like the investors. And so you raise money from investors, and all of that money goes into the asset. And this is specifically called like single asset syndication. Syndication can also be referred to as a fund. Funds can typically buy multiple assets. If you're looking at syndications, they're also called private placement memorandums or private placements. But the basic kind of concept is you are pooling multiple people together. And when I say multiple, I mean kind of like 10 or more. If you're doing 5 or less people, usually you can just structure it as a partnership LLC. And I'm not a tax attorney or a CPA, so I cannot give tax or legal advice. Just disclaimer real quick there. We got into this like 8 unit, and we're like, man, it'd be really cool to syndicate this. And as I was listening to podcasts and educating myself on syndication, like what everyone kept saying is like, you need to mock up a deal. So like to get really comfortable talking to investors, like you need some like materials, you need some marketing before you go put an offer in on a place to buy something where you don't actually have all the money. You need to be comfortable that you're going to be able to perform on that. And so like coming up with all the materials prior to, so this 8 unit that we bought while we were renovating it, doing all this stuff, like over 6 months, we came up with all the materials, and we kind of like pretended like, oh, what if this was a syndication? What if we could offer this? So we kind of like extended that runway for ourselves on what we needed to do in order to like syndicate that property. We still own that property and we didn't actually syndicate it. But the next one that came up was a 9-unit deal. I think you probably saw it on our website.
Yeah.
And we raised $400,000. We were kind of surprised how quickly we could do that. And having a track record in our area and both my brother and I being partners and having a large social network, it came pretty easy. It still was difficult, like learning how to have those conversations, learning how to approach it, like who's going to be good for investing and who's not. And so that's been kind of exciting for us, like learning how to do that. So that deal, we're actually coming full cycle on that. We're putting it up for sale here in, I think, this week or next week. And then we did another 12 unit, I don't know, in 2020. And that one's going up for sale this week too. And once those sells, we're giving investors their money back plus, I don't know, 50, 60% over 3 years. So that's a pretty cool return for them. Exciting for us to go full cycle. What we've been told by people that are farther along than us, that is, as soon as you have a couple under your track record where you've gone full cycle, and by full cycle, I mean buying, doing the value add, and then selling and returning investors money, the money comes a lot easier. So as of right now, we're closing on a 47 unit, about a $5 million raise in the coming week. And we've already raised all that money for that. So it's pretty exciting how quickly in like a couple years, we can go from raising $400,000 to raising $5 million.
Yeah, that's awesome. So I want to dive back into that other one, but you just said it, $4 million on a 40 unit. So you paying cash for that, or is it $200 a door? Like that's a heavy raise on a 40 unit.
47 unit, yeah, $5 million. So we got an assumable loan at 6.2% or 6.2 million at 3.46%.
Okay, so those things are trading $200 a door.
Yeah, Portland market's pretty elevated. So new construction, our median house price is $540K. Apartment doors right now are trading between $200 to $400. New constructions at like $360, $370K a door.
Yeah. Okay.
So
yeah, that's much different than down in all San Antonio here.
Yeah.
It's like,
yeah, for sure.
1 to 120 to 150, something like that. Unless it's class.
Yeah. Well, I mean, we're also looking in Jacksonville, and like there was a deal that came on the market. It was like $90K a door. I was like, oh wow. But then you start looking at the expenses. Like one thing that's interesting is we're looking at other markets now, and the expense ratio to rent, like income to expense, is just astronomical. I mean, there's a lot of people that are like, oh, Oregon's got rent control and all that sort of stuff. Well, there's some other advantages that we do have. Like our expense ratio is very much lower. Taxes are lower, no sales tax. Going to other markets, it's kind of a little bit of a slap in the face to us. We're like, oh man, how are people doing these deals? But I think it just takes a lot of work. It takes getting to know the right people, getting in trained in what's going on. So
let's go back to the 9-unit deal that you guys syndicated. Just finish on. So can you explain the process? Right. Again, looking from the outside in, if I'm an investor or limited partner looking at a deal that somebody's presenting, it may seem like it's fairly easy. Oh, Johnny's bringing a deal or AJ's bringing a deal here. And it's not evident how difficult or how much work is actually put into it. So what did you guys have to do, one, to win that deal? And then all the like steps, I guess, to get it to increase in value. So you guys were able to actually be able to exit now and turn a profit.
And this was a few years ago, so I may be a little off on the numbers, but I'll try to be fairly close. So I believe that we bought the property for 1.25. So it's 9 units at that time. 3-4 years ago, units were trading between 120 and 150K a door. So that was pretty close, maybe a little bit on the lower end there. So that was probably 120, 125K a door, which is pretty good. We found it on the RLMS, and there were jet skis and boats sitting outside. One of the bathrooms had a hole in it. It didn't qualify for financing, so we had to buy it cash.
Got it. Yeah.
We're looking at properties where we used a hard money lender on that one. So we raised 1.25 million. We raised 400K. So we raised about 30%. So we had probably about $150,000 to $200,000 to invest as capital after we had purchased the property. Because I think our lender went up to 90% and gave us a little bit of that construction money. And as a company that has a contractor's license, we immediately control those funds that are dispersed to the contractor. So that's kind of nice. Another reason to have a contracting company along with the property management. So we went in immediately and there was one unit that we like completely gutted because it was vacant and turned into like a model unit. And then it was really just fixing up all the deferred maintenance, like getting the moss off the roof, getting the gutters all cleaned up. We painted the outside because some of the siding was rotten. So we had to do some siding repairs, getting the landscape all fixed up, getting the tenants like, hey, the trash needs to be cleaned up. Jet skis and boats can't be on the landscaping. Going in and giving them all these notices, making sure all the garages all of them were like 2-bedroom, 1-bath or 3-bedroom, 1-bath. And like they all had garages, like all had parking spots. But it's just working class tenants that had maybe a little bit extra income. They had boats and toys and all sorts of stuff that they had on there. So it was really just kind of coming in and cleaning up that property. It took us 3 or 4 months of hard work doing that. And we made a mistake. This is one of our first ones. So like when you jump from residential lending into commercial lending, there's all these different rules. Everything's based on the asset. There's just a different set of rules. So we were 6 months down the line. We're like, oh yeah, let's refinance because that's what we would do if we were in residential, right? Well, it turns out in commercial that if you haven't held the property for more than a year, you can't do a cash out refi. So we went with Fannie Mae, Freddie Mac loan, and they're like, oh yeah, you can only get 1.4 million. We're like, huh? We're like, yeah, it's worth, normally you could do 80% up to 80% LTV, and it appraised for like 1.9 million after 6 months. So we'd almost made 40-50% on it. They would only loan us like $900,000 or $1 million. We're like, okay. And we were planning on using that refinance like cash out to then like go fix up the multiple units. So not having that like capital in the beginning, we still got some back and we use that to fix up the units, but we've just slowed the roll on the other 8 units by just using money from cash flow. We'd re-rent a unit instead of like turn it largely if we didn't have enough capital in the account. So that's kind of why it took a little bit longer than we anticipated.
Can I ask you a question about that?
Sure.
So when you were getting the finance on the front end, did you guys not have the conversation with the hard money lender about CapEx for the turns? Or was that just, how did you guys structure that? Because if they were lending 90% and you guys had the unit repairs, I guess, in the budget, would they have financed 90% of those repairs where it would have been maybe not out of pocket? Or did they do that? Maybe they did that.
Yeah, I mean, at the time, interest rates were super low. So we were looking at 2.85% instead of a 9 or 10%. So we wanted to get out of that hard money as soon as possible.
Sure. Okay. So, but you guys were holding off on the rehab on the interior units until you guys had the capital from the refi. So I'm just saying you didn't want to roll that into the initial loan for some reason. I just didn't understand what the rationale was there. And maybe I'm misunderstanding.
Yeah. So the original purchase price was like 1.25. So the original loan was like 900K. So when we went to refinance, because we hadn't held it more than a year, we weren't able to do a cash out. So they would only do a rate and term, which is pay off that 900K. We had to absolutely fight with them to be like, hey, you need to at least give us like 50 or 70% of the capital we put into the place, because it didn't just go from 1.2 to 1.9 by sitting there for 6 months. So we could only get the loan up to like 980 or maybe 1.1 or 1.2 million for the Freddie Mac. And we had already invested money. Like when you go in to do a Freddie Mac loan, like you got to give them $10,000 up front. And they go do appraisals and phase ones and all sorts of stuff. And like we found this information out like way down the line, when if we would have known it earlier, we'd have scrapped the whole idea.
Sure.
And so we were kind of like pot committed by then. And we're like, the attractive rate of a 2.85% loan as opposed to paying 9 or 10%, that was pretty good. And so we were far enough down the line and we're like, oh, there'll be enough capital coming back that we're still able to do all the turns. It's just going to take a little bit longer.
Got it. Okay. Just to know, again, on the front side, when you're borrowing from the hard money guy, if you guys had thought about rolling the actual cost, that CapEx budget into their hard money loan, and then when you went to refinance, maybe your loan amount, refinance amount would have been higher, but you would have been less out of pocket. But if the property, obviously that delta between 9 and 2.5% or 2.8%, cash flow increases significantly when you do that as well. So
the guys at Freddie Mac, the other lenders, they're pretty savvy, right? They're like, oh, you're not going to get a hard money loan where they're going to loan you 900K and then you're going to have to get another 400 or 500K in budget. So like, it's got to pass the sniff test. And we got as much as we could.
Got it. Yeah.
At the time.
Yeah, for sure. Okay. So then you guys are in the midst of that. Again, you got to the point where you guys stabilized this thing and you've held it for 2 years since then. And you guys, everything's been kind of gravy since then, or what?
Yeah, I think we've renovated 6 more units. So we've renovated 7 of the 9 units. The other thing that we've learned by just doing a podcast and talking to other people is like, sometimes it's good to leave meat on the bone for the next person. And so we had thought about just keeping it longer. And then we like talked to someone and they're like, yeah, if you leave a little bit of meat on the bone, someone else can do a value add and like, you're going to get a higher kind of value than trying to sell this. Like 9 unit is kind of small to be like a perfected sort of product. Not a lot of buyers out there in that kind of like space that want to come in and just manage 9 units. Like they're looking to add some value. So that's why another one of the reasons. And also we keep hearing like, go full cycle with a couple deals. It's going to be better off. So the timing for us is kind of perfect.
Yeah.
We originally committed to like 5 years with our investors, and I've cycled through and talked with all of them, and they're like, yeah, no, this is great. What's the next one? And I'm like, okay, all right.
It's a win in a shorter time frame. They get a win and you get a win. I think all around, if you can do that, it's fantastic.
Yeah.
And to your point about leaving meat on the bone, I've looked at so many deals, 30 to 150 unit style deals. And when one is fully stabilized, like completely renovated, everything is great on it, and you're just buying coupon essentially.
Yeah, you're buying yield, right?
Yeah, it's like there are buyers for that for sure, but it narrows the buying pool, because I'm definitely not looking for that. I need to go in and add some value and then be able to show investors a win, because I'm not necessarily talking to institutional guys who they just need 4%, 5% cap rate, something like that. They're buying that yield. So very good advice there. I had a question, mock up a deal, syndicate. Oh, on the cost to syndicate. Like typically syndicating, you got to go hire an attorney. You got to talk to, have a special account, all that stuff, the accounting side of it set up. What's the cost that you guys were seeing just to set up a small syndication like that? Was it relatively nominal? Because you still, when you do a syndication, you're doing a PPM, you're doing the whole doc set, the offering docs and everything.
Yeah. I mean, there's 10 different ways to skin a cat. I will say that like most attorneys, I don't know how, again, I'm not an attorney and I can't give legal advice, but most of the time attorneys just cost a lot of money. Like anytime that we're in any sort of adverse situation in property management is much, much more cheaper, no matter, even if I have to pay the tenant to just resolve the issue with the tenant myself. Like once attorneys get involved, the costs skyrocket. So that being said, like the attorney is there to kind of like review and put their insurance on it. So when an attorney reviews something, it's like, they are saying, yes, this is good. If something should go wrong with it, I will defend it, or my insurance will pick it up and defend it. So having that attorney's insurance on there is like really one of the big things. I've also always been of the advent of it's better to create something yourself and have it reviewed than have someone else draft something up. So we draft all of our own stuff, and then we have attorneys review it, so that we're under their insurance or whatnot, but it's a significantly less cost to do it that way. And if you're on other syndicators' lists, you're looking at PPMs all day long. Like there's a lot of language out there. I'm not saying
it's a little hack.
Go out there, don't go recreate the wheel. The wheel's out there, it's working, it's turning. Just figure out what works for you and that sort of stuff. And then make sure that you do get covered, like get that attorney to review it. But sometimes it can be someone local, or it could be someone that's SEC like specific. It's kind of like all of your risk tolerance on what you want to do. We only do 506B SEC filings. So 506B says that like the investor has to be known to us prior to investing. They can still be accredited. 506C, you can actually advertise specific deals on like social media or kind of wherever else, but then you can only accept accredited investors. And I think they just upped the accreditation status. Like you have to be making $200K a year, have at least $1 million, whereas before it was like $100K. But they did also add in like if you're a real estate professional or you're a financial professional, then you kind of already get in under the accredited status. So there's some interesting updates that happened in the past couple of years to being an accredited investor, which is kind of cool.
For sure. Okay. That's awesome. I wanted to talk about that deal for sure.
To answer your question, to go back to the actual cost, like we don't have an actual cost. What I can say is that like raising $400,000 to $500,000 for that particular project, it was well worth it. I wouldn't go less than that, and I have not gone less than that prior. So our first raise was 400, our second one was 600, our third one was $1 million, our fourth one was $1 million, our fifth one was $3 million, and our sixth one was $5 million. Yeah. So I wouldn't raise less than $1 million again, just because I do think that those costs probably eat into it a little bit.
Yeah, they do. But I have a small mastermind within a mastermind here in San Antonio. There's a bunch of you guys buying multifamily. And so we all sit around, we're kind of talking, some new people in there, some people haven't done deals and that sort of thing. And one of the things that I talk about is like, you just buy one as a loss leader almost. Like you'll make money on it, right? But the whole idea is to get people into your...
Well, you pay for college, don't you? You pay for education. There's no better education than doing it yourself.
Yep.
And so if you can chalk up some amount and be like, hey, you know what? We're not going to make as much money on this. I'm going to give, as a syndicator, give more money to my investors to make sure that my track record's good, not take as much in fees, and like just get my foot into the market. We definitely started out with higher targets, higher hurdles in our first deals because we wanted people to be confident that we were going to make them more money, and we took less fees. We are taking more fees now.
Yeah, I'm curious. No deal specifics. Obviously, you got above 6 Bs going on. But if you were to think about deal structure now, like what kind of offerings are you seeing either in the marketplace now compared to like 3 years ago? Or how have you guys?
Yeah, I mean, it's inherent. It's inherent. As interest rates go up, IRR is going to come down. People who are chasing returns, it's really tough. So like in the past 3 years, like IRR has just kind of like steadily declined. And I invest in other people's syndications. I want to see their process, how they do things. So I'm on other people's lists, like want to see what they're offering. And I've definitely seen like stuff 3 or 4 years ago when I was like starting to research. I want to say I saw stuff high above in the 20s. I was always kind of very wary of that because the higher IRR, the more risky it becomes. Maybe they're doing something weird with financing, or they're not distributing the first year, or who knows what's going on. But kind of the norm, won't say norm, but a lot of what I'm seeing is between 12 and 20, kind of centered right in the middle there.
Are you seeing pref change? How are you seeing that side of it structured? Is it 7-70-30, 8-80-20, 80-20 straight? Like, I'll explain some of those.
Yeah, I mean, we can talk about waterfalls and structures like all day long. Like once you kind of understand the ways that a structure, like if understanding what pref is, like all those numbers can change, and then waterfalls and hurdles, there's no regulation on it whatsoever. I mean, the SEC doesn't say you can or can't do this or what can or cannot be done. So there's a great book out there by Brian Burke. It's The Hands-Off Investor. And he goes through how to be an LP, what questions to ask. So LP and GP are the two terms. GP is the general partner. LP is the limited partner. Also could be referred to as sponsor and investor. Investor being the LP, sponsor being the GP. But he goes through all the terminology, all the structures, what to look for, what questions to ask the sponsors, how to vet the sponsor, how to vet the deal. The main theme is vet the sponsor, not the deal. A good deal can be screwed up by a bad sponsor. A good sponsor can turn a bad deal into an okay deal. Good sponsor can turn a good deal into a great deal. Bad sponsor can turn a great deal into an awful deal. So it's really about the person performing it and like what they can and cannot do on what their experience is.
Yeah. Well, we are getting to the end, but I wanted to ask you, you say you have a podcast, right? So, and you coach up on getting into syndication. So what's your best advice for real estate agents or real estate professionals in general who maybe haven't gotten into this type of investing with the syndications, or even just going out and buying their first house as an investment? What would you say to them?
My best advice, when I was like really starting to get into research, I got a new car and I turned my car into podcast, books, listening, audio, like as I was driving around. Like the continual education of yourself and investing in yourself is probably, I think, the number one thing that you can do. Even by listening to this podcast, you're probably on your way there, but continue to seek out podcasts and other books in the areas that you want to learn and that you want to grow in. And then don't be afraid to take that first step. Like, even if you don't make money on the first one, the experience that you're going to gain through taking a first step is going to be monumental. There's no substitute for doing.
Yeah. Great advice. I want to wrap it up. A couple questions real fast. What's your best or your favorite pastime not related to business?
I have so many, but I would have to say boating, and like I kiteboard, snowboard, surf, and then I also play a lot of golf. So
very cool. Yeah. All right. If I'm ever up there, you got to take me to all of those.
Yeah, for sure. Come in the summer. It's rainy and miserable here right now. I'm ready to go back to the sun.
Yeah, I've got a couple friends that live up there. They just moved up. But all right, so that's cool. Very cool. Very similar interest in that front. What about something great that's happened to you or your family in the last 60 days or so? What stands out?
It's actually something great that's about to happen. My brother is about to have his first baby. So that's exciting for our family. I don't have any kids yet either. So that's pretty exciting.
That is very cool. Going to be an uncle. All right. That's cool. Congrats.
Thanks.
And then name one or two people who've been most influential to the way you think or your success.
I mean, my dad, he was in real estate prior, has always kind of been like, own, don't rent. In order to create wealth, you have to own things. So that's been pretty influential. I had a mentor kind of like in the construction company, and he was another mechanical engineer. And he was very good about giving me something to do, but not letting me know how to do it. And that sort of critical thinking that I had to develop, even though like I made some mistakes, and like looking back, I know I made some mistakes, but the ability to learn and try and fail and have that safety net was pretty influential and helpful. Having that confidence to know that like I'm going to be able to pick myself up and continue on as I got out onto my own was super helpful.
Yeah. And that's great advice. Great tip of way to do things. I think about that a lot with my kids now. So with little nephew coming along, boy or girl, do you know?
That's a boy.
Boy, yeah. So let's just try to do some of that. It's a constant thing. So AJ, it's been awesome getting to know you. I appreciate you sharing your knowledge and information. I'm going to link to some contact information to you in the show notes, if that's all right.
Awesome.
So people can reach out to you directly.
Listen to my podcast, the Westside Investors Network, WIN for short.
Yeah, I saw that on your website too. It's awesome. So we'll plug all that stuff down in the show notes. You guys check it out. It is awesome, and they're doing some good things. So thanks, man. Catch you on the next episode.
Yeah, thanks for having me. Appreciate it.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.